Picture this. You check your savings account, and as you watch the screen, that number staring back at you is shrinking. Not because you are spending anything, but because as you breathe, someone else is quietly erasing part of your wealth. Sound like science fiction? It's happening right now, and the mechanism behind it involves the largest financial sleight of hand in human history. The United States government owes $38 trillion. That's not a typo, $38 trillion. To help you wrap your head around this astronomical figure, imagine stacking 38 trillion $1 bills on top of each other. That tower wouldn't just reach the clouds or even the edge of space. It would soar past the moon and keep climbing into the void. For decades, politicians have stood at podiums with reassuring smiles, telling us not to worry about this number. Economists have written lengthy papers explaining why deficits don't really matter, claiming it's just money America owes to itself. They've treated this debt like a high score in a video game, intimidating but ultimately meaningless. But something fundamental shifted in 2024. The mathematics stopped being theoretical and became predatory. For the first time in American history, the federal government now spends more money on interest payments than on the entire United States military. Let me repeat that because it's crucial. More on interest than on defense. More money goes to paying off bondholders from decades past than to equipping the soldiers, ships, and aircraft protecting the nation today. The annual interest bill is rapidly approaching $1 trillion. And this isn't just another line item in the federal budget anymore. It's a beast, and it's feeding voraciously on the financial future of every American citizen. Here's where the situation becomes truly terrifying. When a typical family accumulates too much debt, they make hard choices. They stop dining out, cancel subscriptions, cut expenses until the numbers balance. But governments operate under entirely different rules than households. A massive portion of the federal budget is locked in stone, politically untouchable. Social Security and Medicare represent promises made to millions of aging Americans. No politician can slash these programs without committing career suicide. Since the government cannot reduce spending, it faces a cruel mathematical trap. To pay the interest on yesterday's debt, it must borrow more money today. It's essentially using a new credit card to make minimum payments on the old credit card. This increases the total debt load, which increases next year's interest payments, which demands even more borrowing the following year. Once this feedback loop begins, mathematics takes control. The debt doesn't grow in a straight line anymore. It accelerates exponentially, faster and faster with each passing month. So how does a nation escape a debt trap of this magnitude? Economic theory offers exactly 3 potential exits from this burning building, but 2 of those doors are sealed permanently shut. The first option economists call austerity. This would require the government to raise taxes dramatically while simultaneously cutting spending brutally. To actually balance the budget and begin paying down the debt, the government would need to implement something truly extreme. They would need to double income taxes on every American citizen or completely abolish the United States military. Neither scenario will ever happen. Any politician suggesting a 30% reduction in Social Security payments would end their career instantly. Any president proposing a 70% tax rate would lose the next election in a devastating landslide. The American economy has developed a dangerous addiction to government spending. Suddenly cutting off this financial flow would trigger an economic collapse that would make the Great Depression look like a minor recession. So austerity remains impossible. The second option is outright default. The government could simply announce that it refuses to pay its debts. Countries like Argentina and Russia have chosen this path before. But for the United States, this represents the nuclear option in financial terms. The entire global financial system rests on one fundamental assumption, that United States Treasury bonds are completely risk-free. Every bank, every pension fund, every international trade contract is built on this foundation. If the United States defaults even once, that assumption crumbles instantly, and the dominoes begin falling worldwide. Banks across the globe hold trillions of dollars in treasury bonds as their safest assets. If those bonds become worthless overnight, those banks collapse. When banks collapse, credit vanishes. When credit disappears, businesses cannot meet payroll. Supply chains freeze solid. Grocery stores would run out of food within days. It would represent a financial apocalypse. So explicit default is also impossible. That leaves only one remaining option. The third door, the path that every empire throughout history has eventually chosen. Rome took this route. Weimar Germany walked through this door. Post-war Britain made this choice. It's the path of least resistance, the quiet solution that politicians never discuss openly. This is called the soft default. The government doesn't refuse to pay the debt. Instead, they honor every single cent of their obligations, but they repay those debts in currency that's worth significantly less than when they originally borrowed it. They manufacture the difference through monetary expansion, essentially printing their way out of the crisis. This isn't theoretical speculation. This is official policy, though it's never stated explicitly, and the process has already begun. To understand how this wealth transfer mechanism works, we need to examine the specific tools the government employs. These aren't accidents or unintended consequences. They're carefully designed systems for moving wealth from your pocket to theirs. The first tool is the creation of captive buyers. In a genuine free market, if a borrower owes $38 trillion and continues spending recklessly, lenders would demand higher interest rates as compensation for the increased risk. They might demand 10 or 15% returns. But the United States government cannot afford those rates. At 10% interest, the annual interest bill would reach $3.8 trillion, exceeding the government's entire tax revenue. So they've rigged the game by creating artificial demand. Through complex banking regulations like Basel III and Dodd-Frank, the government forces banks, insurance companies, and pension funds to purchase treasury bonds. Regulators classify these bonds as high-quality liquid assets, making them legally required holdings for financial institutions. It doesn't matter if these bonds pay minimal interest or lose value through inflation. Banks must buy them to remain in business. This creates something extraordinary in economic terms: guaranteed demand regardless of price or risk. Your pension fund isn't purchasing government debt because it's a sound investment. It's buying because a federal law mandates it. The second tool involves manipulating inflation measurements. Social Security payments and Treasury inflation-protected securities are tied to the Consumer Price Index. If official inflation reads 10%, the government must increase payments by 10%. This creates a multi-billion-dollar incentive to keep official inflation numbers as low as possible. Since the 1980s, the methodology for calculating inflation has been quietly rewritten to suppress the reported numbers. They introduced something called substitution bias. The logic works like this: if steak prices double, people will switch to hamburger instead. Therefore, the inflation calculation tracks hamburger prices, effectively ignoring the fact that living standards have declined. Citizens are eating lower quality food, but the government claims inflation remains under control. They also implemented hedonic adjustments. If a new car costs $5,000 more than last year's model but includes better safety features, the government argues the price didn't really increase. They adjust the number downward because quality improved, even though families can no longer afford the vehicle. These statistical manipulations save the government billions annually. If we calculated inflation using 1980s methodology, the current rate would consistently be double the official figures. The government is systematically lying about the cost of survival to protect its budget. The third tool represents the death of central bank independence. Historically, the Federal Reserve operated independently, with its primary mission being protection of the dollar's value. Under the current system of fiscal dominance, the Fed has lost this independence. Its primary job has become keeping the Treasury financially solvent. When foreign nations like China and Japan reduce their Treasury bond purchases, which they've begun doing, the Federal Reserve steps in as the buyer of last resort. It creates new money digitally and uses those funds to purchase bonds that nobody else wants. This process, called quantitative easing, artificially suppresses interest rates by creating fake demand. By purchasing government debt, the Fed keeps the government's interest costs manageable, but it floods the economy with newly created dollars. This triggers asset price inflation. Stock markets rise, real estate prices soar, and asset values disconnect from underlying economic reality. This creates what economists call the everything bubble. It generates an illusion of prosperity. Your investment account shows higher numbers, your house appears more valuable, but it's essentially a monetary mirage. You possess more dollars, but each dollar purchases less than it did a decade ago. The government is effectively paying off its debts by diluting your share of the economic pie. But this process doesn't affect everyone equally. In fact, it serves as the primary engine driving the growing inequality that's tearing American society apart. To understand why, we must revisit the work of an 18th century French economist named Richard Cantillon, who identified what's now known as the Cantillon effect. Cantillon realized that where new money enters the economy determines who benefits and who suffers. When the Federal Reserve creates $1 trillion, they don't distribute it evenly to every citizen. They don't drop it from helicopters over small towns. Instead, they inject it directly into the financial sector, purchasing bonds from institutions like Goldman Sachs, JP Morgan, and BlackRock. These financial institutions receive the new money first, fresh from the digital printing press, at zero interest cost. They immediately deploy this capital, purchasing stocks, real estate, technology companies, art, and other value-storing assets. By the time this newly created money trickles down to average workers through wages and paychecks, prices have already exploded. Rent has doubled, groceries cost 50% more. The wealthy receive the money before inflation impacts prices. The working class receives it after inflation has already struck. This explains why America now exhibits what economists call a K-shaped economy. The asset-owning class, roughly the top 10%, has seen their wealth skyrocket. Their stock portfolios have increased 300% since 2008. Their homes are worth double or triple their original purchase prices. Meanwhile, the wage-earning class, representing the bottom 90%, watches their purchasing power collapse. Their paychecks buy less each year. They cannot afford homes. They cannot save for retirement. The middle class is being systematically liquidated, not by accident, but by deliberate design. This represents the end of what we might call the risk-free era. For the past 4 decades, standard financial advice was straightforward. Work hard, save 10% of your income, deposit it in banks, purchase government bonds, and retire comfortably. This was the classic 60-40 portfolio, designed for a world where money maintained its value over time. But that world has vanished. In today's environment of fiscal dominance, this traditional advice amounts to financial suicide. If you save money in a bank account, earning 4% interest while real inflation runs at 8%, you're losing 4% of your wealth annually. Over 10 years, you'll sacrifice 40% of your purchasing power. If you purchase government bonds today, you're guaranteed to lose money because interest rates remain below inflation rates. The system has been deliberately designed to punish savers and reward speculators. To simply preserve wealth now, individuals must accept risks. They must purchase stocks, real estate, or cryptocurrencies. They must speculate just to maintain their economic position. The government has transformed the entire economy into a casino where people must gamble merely to survive, because the traditionally safe option of saving is being systematically destroyed. But there's one final tool in the government's arsenal that hasn't been fully deployed yet, though it's currently under development in the basement of the Federal Reserve. This is the central bank digital currency, or CBDC. Right now, the government's control over monetary policy remains limited because physical cash still exists. If the government implements negative interest rates to accelerate wealth confiscation, people can simply withdraw cash and store it outside the banking system. Physical currency serves as an escape valve, a method for exiting government control. A CBDC eliminates this option entirely. If the dollar becomes purely digital, the Federal Reserve gains total control over every transaction. They can implement negative interest rates instantly, automatically deducting 1% from your account balance monthly. You cannot prevent it. You cannot withdraw funds. They can program expiration dates into money, requiring you to spend stimulus payments within 30 days or watch them vanish. They can control your purchasing choices, blocking transactions for alcohol, firearms, or any items they deem inappropriate. This isn't science fiction speculation. China is already testing similar systems with their digital yuan. Citizens in certain regions can only spend their money on government-approved items. The expiration dates are real. The control is absolute. The United States is carefully observing and learning from these experiments. The digital dollar represents the ultimate solution to the debt crisis. It provides the government with power to micromanage every economic transaction, to confiscate wealth through simple keystrokes, and to eliminate any ability to save outside their controlled system. The transition to a cashless society isn't about convenience or efficiency. It's about establishing complete control and ensuring there's no escape route when the wealth transfer accelerates. History provides a chilling precedent for what happens when governments become truly desperate. On April 5, 1933, President Franklin Roosevelt signed Executive Order 6102, making it illegal for American citizens to own gold. Anyone caught possessing more than a small amount faced 10 years in federal prison. The government forced citizens to sell their gold to the Federal Reserve at a government-set price. Months later, they revalued gold at a significantly higher price, effectively confiscating wealth legally under the banner of national emergency. The same legal framework exists today. During a crisis, the president maintains the authority to seize assets including gold, Bitcoin, and retirement accounts. The verdict should now be crystal clear. The United States is defaulting on its obligations right now. It's not a sudden dramatic crash or a shocking public announcement. Instead, it's a slow, polite, bureaucratic process, but it represents a default nonetheless. The $38 trillion will never be repaid in real purchasing power terms. The government is wagering they can inflate away the debt faster than the public can recognize what is happening in panic. They're walking a dangerous tightrope. If they expand the money supply too slowly, the debt burden crushes them. If they create money too rapidly, they risk triggering hyperinflation that destroys the currency entirely. So they're aiming for the middle path, 4 to 5% inflation sustained over a decade. This might sound manageable, but the mathematics are brutal. At 5% inflation, the value of savings is cut in half every 14 years. By the mid-2030s, half the national debt will be eliminated, and half of every American savings will disappear alongside it. The winners in this system will be those who understand the game being played, those who own scarce assets that cannot be artificially multiplied, real estate that cannot be printed, gold that cannot be created by computers, Bitcoin with its mathematically fixed supply, and profitable businesses that generate genuine economic value. These represent the lifeboats in this economic storm. The losers will be those who continue trusting the system, keeping their wealth in cash, believing government bonds provide safety, or thinking their savings accounts protect them from inflation. The American dream of saving your way to prosperity has died. We've entered an era of asset survival, and the clock is ticking relentlessly. The government has made their choice crystal clear. They will not cut spending significantly. They will not raise taxes to levels needed to address the debt. Instead, they will inflate, and they'll continue this process quietly until it becomes too late for most people to protect themselves. The question facing every American isn't whether this will happen. The evidence shows it's already underway. The real question is what you'll do about it. The debt is being systematically erased through inflation, and your wealth is disappearing through the same mechanism. The time for action is now, before the final tools of control make escape impossible. This represents more than just an economic crisis. It's the controlled demolition of the American middle class, executed through monetary policy rather than direct taxation. Understanding these mechanisms is the first step toward protecting yourself and your family from becoming casualties in this historic wealth transfer. The warning signs are everywhere for those willing to see them. The debt clock in Times Square spins faster each day. Interest payments consume an ever-growing portion of the federal budget. Foreign nations reduce their treasury bond holdings while the Federal Reserve fills the gap with newly created money. Asset prices disconnect from economic fundamentals as excess liquidity floods into investment markets. Your savings account balance might look the same today as it did last month, but its purchasing power is quietly evaporating. This isn't happening by accident or through natural market forces. It's the result of deliberate policy choices designed to transfer wealth from savers to the state, from the productive economy to the government sector, from your pocket to theirs. The American government won't default in the traditional sense. They won't stand before the world and announce they're walking away from their obligations. Instead, they'll honor every payment while ensuring those payments are made in currency worth significantly less than when the debts were incurred. It's default by debasement, bankruptcy by inflation, and the greatest wealth redistribution scheme in human history. Time is running short. The mechanisms of control grow stronger each day. The window for protecting yourself is still open, but it won't remain so indefinitely. The choice is yours. Become a victim of this historic wealth transfer, or take the steps necessary to preserve your economic future in an age of monetary manipulation. The $38 trillion debt isn't just a government problem. It's your problem, because you're the one who's ultimately going to pay for it one way or another. The only question is whether you'll pay knowingly and take defensive action, or unknowingly watch your wealth disappear into the machinery of controlled inflation. The debt is being erased, and so is your purchasing power. The time for complacency has ended. The time for action is now. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.